Great to see a lot of us back in the office. So things are really getting back to normal, and it's exciting to see that. I've been here since 2005, so most of you, I think, know what I do. I certainly know I play golf badly and continue to do that badly, but that's another matter. You're going to get 1 credit for the presentation today, as you know. And I had Blake send over, I assume he sent over outlines of some of the client-facing outlines that we generally provide to clients on some of the wealth transfer and other strategies that we implement for clients, as well as creditor protection. The slides for today's presentation should also have been provided. If you don't have them or need them, Blake can get them to you.
I got it.
They're going to be sent in the follow-up email, Steve.
Okay, thank you. I'm not going to discuss most of the material in there. We'll touch on a couple of things, but certainly once you hear what our department practice is about, you'll appreciate what all of that means, and they're very helpful for your clients who may need our services. So the first thing I wanted to do was kind of talk about our roster of players in the tax, trust, and estates group, give you an idea of what each of us does. I obviously coordinate the practice, but we all have certain specialties, and there's a lot of overlap, which will help you understand where you need to go for particular needs for your clients. I'm going to share my screen. Let's see here. Sure. Okay. Does everyone have that? Yes. So this is kind of the roster of the people in the estate planning group. I chair the group. I've been doing that since 2005. If for no reason, because of my advanced age, I've done a lot of different things in the tax area. I also support our corporate practice, mostly in the area of tax sensitive corporate transaction planning, and represent a number of closely held businesses as their general counsel. So I've practiced, as has Marty, for my entire career as a corporate attorney. I actually started out doing M&A support on the tax side, and so mostly in the corporate world. Over the course of my career, I sort of taught myself the estate planning area, and really now focus probably around 50% of my time on sophisticated estate planning. Estate planning really consists of creating testamentary documents for clients to control the passage of their assets at death, but it also involves, and probably more importantly with many of our clients, structuring wealth transfer strategies, finding ways to transfer assets in tax efficient ways to save estate tax. The orientation of an estate plan to a large extent is driven by tax considerations. Anybody with a reasonably large estate has to take that into consideration, especially if you live in New York. And unfortunately, we believe in the future in New Jersey. We expect New Jersey to be reinstating its estate tax sometime in the near future. We also represent clients that don't necessarily have a concern about estate tax savings. There's really no benchmark for what clients are of interest to the group. We'll do wills and trusts for anybody that needs them. We price to take account of what's affordable to them. I have a great document bank and a great long-standing relationship with Diane Lennox, who has been associated with me in one way or another since 1986. So we've developed a really terrific platform of documents. So even smaller estates, you should certainly steer our way. Everybody needs a will. Many people need trusts. I don't do what Richard does. I don't deal with special needs trusts or planning for people with special needs. Generally don't deal with the elder care planning. Our focus is really more on high net worth estate planning. We get our clients through accountants, financial planners. I work with a great number of corporate executives. I have a niche in that space. And again, the focus is on getting the testamentary plan in order in a way that makes the most sense for the family and protects the family, while at the same time creating opportunities for saving estate tax, dealing with wealth transfer strategies, and there's multiple different techniques that are used for that. Some of the outlines, by the way, delineate some of these techniques. I've tried to make them client facing so they're fairly easy to understand. Some of the techniques are fairly complicated. I'll get into a few of them today. But the process of estate planning, can be really a lifetime arrangement with a client, depending on the level of wealth. Things are always changing in the estate and trust area. Obviously also with family dynamics. And it's important to keep ahead of clients on what they need to do to minimize taxes, deal with family changes, and incorporate planning and wealth transfer techniques that are beneficial to them to save estate tax. Today, the estate tax exemption amount is 11.7 million per spouse. So you could theorize that a couple with under $23 million of assets maybe doesn't need estate planning. It's a little bit of a misnomer to think that way, because the generation skipping transfer tax is a different tax and doesn't create the same opportunities for planning as under the estate and gift tax. So you really have to kind of look at whether you've covered multi-generational planning, as well as the anticipation of changes in the tax law, and the potential for reductions in the exemptions or increases in asset values within a family. We do lots of gift and wealth transfer strategizing with clients who have well under that number. There are ways to create estate tax savings for multiple generations, even for smaller estates. So, anybody that comes to you and says, I haven't done any estate planning, what should I do? Being aware of the fact that the exemption amount is very significant, really should think about a lot of other issues that go into the estate planning process, even on the tax side. 11 states still have an estate tax. New Jersey, until 2017, had the highest estate tax in the country. New York has an estate tax, although the exemptions are relatively high. I think New York is now at 5.85 million per spouse. But the point is, this is not a process for the uber wealthy. For us, it's a lot more fun with the uber wealthy. We do really sophisticated wealth transfer structures. And again, it's ongoing, potentially for generations. The best strategy for us is to meet with the patriarchs of a family as well as children, and really help them develop a long-term estate and financial planning strategy, really to save estate tax and to protect the family wealth. We work very closely with accountants and financial planners. I think they're an integral part of the process, as well as people in the insurance business. So yeah, again, the points of contact for you potentially are accountants, financial planners, insurance professionals. I mean, just about in every practice area, I know that we cross paths with insurance professionals. Their motivation is to sell insurance, but we've learned that working with them in a cooperative way in a sophisticated estate planning setting gives them the opportunity to sell products, and they appreciate that from us. And there's a lot of room for life insurance in an estate plan. I'll get into some of the more details on that later. We all do estate administration. I would say that Lisa Fox is primarily on top of that, particularly for New York. Diane Lennox really handles the estate administration on a very macro level. She deals with all of the nuances of the administration. My role, Lisa's role, Marty's role, is to kind of look at the strategies for what to do during administration, whether there are tax savings opportunities, whether there are other nuances of the plan, including how to liquidate assets, what assets to keep, how you plan for the payment of estate taxes, and ultimately preparing the estate tax returns for many estates. But Diane is really instrumental, as is Patty, in actually moving the estates through. We do primarily New York and New Jersey. I've had a few in Florida. Normally we get co-counsel there. Florida's complicated. Very, very important. And, you know, estate administration, although it's a very emotional time for the families, is a lot of pushing paper around and making sure that you deal with very nuanced procedures from the surrogates offices in the counties in the state. And Diane and Patty are very, very good at keeping that flow going. Given my background in general taxation, I have an LLM in taxation from NYU. I also advise corporations, individuals, partnerships on really just about any tax matter. Marty and I, you know, grew up being you know, mainstream tax attorneys. So, and since we were both started out in relatively small firms, we got the opportunity to see any number of tax-driven issues, transactions. So our focus, you know, ranges from, you know, detailed knowledge of the corporate partnership and individual tax laws to dealing with employee benefits planning and tax implications. I do a lot in international taxation, mostly on the inbound side. I wouldn't say that we're particularly strong on representing multinational companies, although we can certainly address their US tax implications as well as the tax implications to foreigners. We have a lot of depth there. We also run the exempt organizations practice for the firm, which is again pretty tax driven. I'm chair of the exempt organizations practice group. Lisa Fox is very involved, particularly with private family foundations. I would say the firm probably represents 100 or more private family foundations. It's a really exciting opportunity for families that want to create long-term charitable giving strategies within their families. Something that probably will come up more than once in your careers when you're talking to clients, and we can really help them with both the creation of those programs, compliance, and administration. A couple of us work in the area of creditor protection planning. We do it at a relatively high level. Creditor protection can start from the simple process of giving assets to your spouse. Your spouse is not you. Your spouse is not subject to your claims. As long as you don't transfer the assets while your or a claim is being pursued against you, that's very effective planning. But that has its own problems. Because it only lasts while the couple are both alive. Probably at the highest level, I do creditor protection plans using trusts in creditor protection states. There are now 19 creditor protection states. The most recent one is Ohio. I do most of these in Delaware. I've done 50 of them in my career. I have a few in Alaska. We're starting to use Wyoming. And I did one in Ohio. Where you go for creditor protection depends on the statute and the availability of trustee relationships. Ohio is appealing, particularly because the statute of limitations on a creditor's ability to pursue a claim against the trust assets is the shortest of any of the states, 18 months. Most of the states have a 2-year statute. Delaware has a 4-year statute. We do these for physicians, business owners, corporate executives, entrepreneurs, professionals, anybody who's got a potential for credit or risk that they're uncomfortable with. The use of a creditor protection trust is an ideal opportunity, because if the assets are stored in the trust for a certain period of time, then any claims by the grantor of the trust creditors are barred by the state statute of limitations, and the state will not hear the action. It is barred. The Chancery Court will shut it down. So it's very effective. Creditor protection trusts are also very flexible. The person who sets up the trust has a right as a beneficiary to get the assets under certain circumstances. I sent in the materials that you'll see like a one-page outline, easy to understand exactly how this all works. Very effective planning and very important for a lot of our clients. And I think that's one of the touch points that I think everybody will reach at some point when clients are looking to protect themselves and their assets in just about any setting, environmental, litigation, matrimonial, to some extent. We also do a lot with executive compensation planning, deferred compensation planning, and then we support the corporate practice group on any tax sensitive transaction planning. One message that tax attorneys try to get through and are frustrated that sometimes it hits a wall is that any transaction is going to have tax implications. Too often, and it's nobody's fault because the momentum of a deal, it has its own life. Too often we're asked on the tax side, whether something will work, and from time to time it doesn't, even though the planning has all been done. So my request for you would be to get to us sooner than later. We can certainly add value to the practice, and sometimes the way you structure a transaction is going to really be tax beneficial for your clients. So it's important to take that into consideration. We have a great deal of expertise in that space and a lot of experience. Marty has a really fascinating background. He does a lot of things that I do, but in addition to being a tax attorney, estate planner, Marty is our resident specialist in tax controversy and dispute resolution. He handles matters throughout the United States, state level and federal level, whether it's in the ERISA, estate and gift, excise tax, income tax, or what have you, for individuals, corporations, partnerships, other entities. His track record is stellar. Most of the results he gets are very favorable to our clients. He can help our clients set up payments plans, offers and compromise, get rid of penalties, reduce the tax liabilities. And if you look at some of our past offerings that we've sent to our clients, you'll see some of Marty's successes. He's the only one that does it. He's the only one that has to do it. He's very, very effective at it. Marty is also chair of our ERISA practice group. Marty represents qualified plan fiduciaries, both on the design, compliance, and taking corrective measures where plan fiduciaries have not administered the plan consistently with ERISA. Marty was one of the premier and first attorneys to practice in the ERISA area in the United States. He picked it up literally when it was adopted a few years ago. I won't disclose how many. And he is recognized in the tri-state area and elsewhere as one of the leading experts in the space. We can help your clients in their retirement planning. Many clients who want to transition their business might come up with a qualified retirement plan as their exit opportunity. Marty's very familiar with all of those things. You all know Alan. Alan is also an estate planner. He does real estate, estate administration, and he is also a tax attorney by background, working in a lot of the areas that we work in. Alan is of counsel to the firm. He's available to take on cases, and as you know, he refers in a lot of cases. Lisa, who everybody knows, is our preeminent expert in many areas of the estate tax law and the generation skipping and gift tax law. She describes herself as an estate tax geek, and she really is. She's a great resource in the very sophisticated planning we do. She represents clients in the estate planning area, doing a lot of the things that I described earlier, estate administration, most notably in New York. And she's a great resource for all of us who are planners. And just about everybody in the tax group is an estate planner. It's a really important part of what we do. And it gives great opportunities for referral business because, again, everybody we deal with on a day-to-day basis, accountants, financial planners, insurance people, other financial professionals, they're all looking for this, and the opportunities are really open. So it's a relatively easy, low-hanging fruit for you guys to, find opportunities to bring new business in. Tom Ackerman is also an estate planner and tax attorney by background. He focuses more in the corporate area, as you know, but he has a lot of knowledge and experience. Mark Comer does estate planning, tax work. He represents clients below the Mason-Dixon line, Monmouth County and lower. So anything that you need, if you have a client, one of the phenomenon I've been told, and I've appreciated it and dealt with it, is that clients, below the Raritan Bridge like to work with local attorneys, and that's really been kind of the case. So anybody in that neck of the woods, Mark is available to help. He's right there. He has an office there. Diane and Patty do our drafting and estate administration. Diane is probably a better estate planning document drafter than most attorneys. I don't say that lightly. If you have a simple matter, your grandmother or your friend or somebody wants a simple will and they don't need complicated planning, just as long as you give me a heads up on it, you can just go to Diane directly. She knows exactly what you will need. She knows exactly what questions to ask. So if you're looking for a streamlined way to turn around a simple set of wills, powers of attorney, living wills, maybe even an insurance trust, Diane will be the one to help you with that. Patty works primarily with Richard, and as you heard last month, Richard also does some estate planning, and Patty works with him as well as on estate administration projects for all of us. Our emeritus members of the group are Casey, who's really kind of transitioned more to the corporate practice group, Richard, who chairs our elder law practice, and Shauna, who works with Richard. Any questions on any of that before I move on? Anybody? Okay. I thought it'd be helpful for everybody to have a few minutes from us on what's happening in Congress on the federal estate and income tax platforms. There are 3 bills in Congress that have been introduced, and President Biden, as you probably know, just published his so-called Green Book, which is his budget proposal, which includes tax law changes. I'm hearing from a lot of clients who are freaking out a little bit about the Biden proposals and scrambling to deal with them. They're not quite fully informed, however, because there's nothing been introduced. Biden put together a budget proposal, and it included some tax law change opportunities. Those are not in Congress being debated. They haven't been introduced into committee. So absent an aberrational and constitutionally challenged attempt to make any tax legislation retroactive, those could not be effective until they're introduced into committee. So they haven't been. So there's no time to panic yet. But when you see them, even for your own benefit, you're going to panic a little bit, because it's pretty serious stuff in terms of what we can all expect to pay by way of taxes in the future. The way the process works is that the bills are introduced into committee. Normally, they're attached with an effective date. Some of the provisions may be effective on enactment, and they could be effective on the date of introduction. So apropos of that, Bernie Sanders introduced a bill on April 15th. It has an effective date of 1/1/22. A couple of the provisions will be effective upon enactment. How it's going to get done, if it gets done, it'll require 60 votes in the Senate, which he's not going to get, or theoretically 50 votes plus Vice President Harris if it's done through the budget reconciliation process, which is likely what is going to happen. Although that's a guarded legislative process and is only used guardedly because you can only use it every 18 months. That's how President Trump got his legislation through in 2017. The problem with operating under the budget reconciliation process is that the bill can only last for 9 years. So I'm sure you're all aware of this, but if you're not, all of the Trump tax law changes, except the corporate tax rate, are going to sunset in 2026. So all the goodies that we got are gone, particularly the $11.7 million estate tax exemption. If in fact Congress does not act before January 1 of 2026, the exemption is going to be reduced to about 5.8 million. So I think when you're talking to clients about estate planning, they shouldn't get too excited about the 23 million per family, because not so long from now, it's going to be 12 million, and it's going to make a difference at that time. So here's what the Democratic Party supported Bernie proposal looks like. Bernie wants to eliminate the favored treatment of capital gains completely, meaning that a capital gain will be subject to a potential 39.6% tax rate, plus the Medicare surtax, which is 3.8%. Today, it's 20% plus 3.8%. So that will be a doubling of your capital gains. Since Biden is of the same mind on this, there is clearly going to be some change in the capital gains tax rate. That rate also applies to what are called qualified dividends, which are dividends paid by companies that are not capital gain dividends. You might notice when you look at your financial statements from your financial advisors that all of your ordinary income is taxed at 20%. That'll change to 39.6 or greater. Bernie also wants to ratchet up the ordinary income tax rates to a high of 59.8% for taxpayers with 10 million of income or more, and with a ratchet up starting at a relatively low number of 250,000. These are serious things for our clients. And from a planning point and a touch point, if you have a client thinking about selling their business, I think you got to do it this year. You still can lock in the 20% on most of the gain. If you've got the choice to do it this year versus next year, this is the year. So I'm sure our corporate partners are going to be very busy later in the year if this thing takes momentum. Sanders would also want to increase the C corporation tax rate to 35%, which is where it was before Trump, and eliminate all the goodies that Trump gave U.S. corporations in dealing with the repatriation of offshore profits from offshore businesses. That'll all go back to where it was before the Trump changes. Sanders has been very adamant about his dislike of the opportunity for high net worth individuals to pass substantial wealth free of estate tax, including through multiple generations using the generation skipping exemption. So he wants to really gut the estate tax. He wants to reduce the tax exclusion to 3.5 million. Reduce the gift tax exclusion to 1 million. He would retain portability, meaning that your unused exemption would pass to your spouse at death. And then look at the rates he wants to charge: 45% above 3.5 million, 50% if you're over 10, 55% over 50 million. And then, not that we have too many clients like this, 65% for estates valued at over 1 billion. You know, on a philosophical basis, all of the wealth that people have accumulated has been taxed already, right? 40%, 50% if you live in New York. Now there's going to be another haircut at the time of death. You know, from a policy perspective, this is a bit aberrational, and we believe that. He will preserve some special opportunities for farm and certain real estate investments. We don't think this is going to take a lot of wind as it goes through Congress, but certainly there is continuing discussion about reducing the exemption amount. Probably the most problematic part of this is not so much the reduction of the exemption, but the fact that while now gifts and the gift tax and the estate tax regime are what are called linked. In other words, you get an exemption, you can either use it by making gifts during lifetime or preserve it and save estate taxes at death. He wants to unlink the gift and estate tax and reduce the amount that you can give during lifetime to a mere $1 million. Today, a couple with $23 million could give it all away and pay no estate tax and no gift tax on that amount, plus whatever it grows to. So if they give away their 23 million today, and at the date of the survivor's death, it's worth 50 million, they have passed 50 million free of estate tax. That opportunity would go away under Sanders. There would be virtually no opportunities to make gifts during lifetime in a very creative way. These following provisions would have an earlier potential effective date. In other words, the date of enactment, not January 21. He wants to reduce or eliminate the step up in basis for property held in a grantor trust. A grantor trust is a trust, it's an irrevocable trust that for various reasons causes the income to be taxed to the grantor. There are a number of powers that the grantor can possess that allow for the gift to be a completed gift for gift and estate tax purposes, but the property in the trust is treated as if the grantor still owns it for income tax purposes. So Sanders would want to disallow the step up in basis for assets in a grantor trust.
Send that back because I shot that question to him, I think.
Did someone have a question? Oh, okay. One of the techniques we use, and I sent you a little write-up on it, is the family limited partnership. We use LLCs, actually. This is an opportunity for a family to combine wealth in a partnership, give away interest in the partnership to children and grandchildren, and take deductions for the gifted interest on the theory that the gifted interest is a minority interest in a closely held business that can't be sold or liquidated. That creates a valuation reduction. Sanders would take away that deduction in all cases where the family partnership owns non-business assets. Another technique we use is called a GRAT. I gave you a little write-up on it. A GRAT is a process where a grantor would put assets in a trust for a certain number of years, and receive cash flow from the trust at a given amount for that number of years. And then at the end of that term, the assets in the GRAT pass to his children or grandchildren. And there are substantial estate tax savings in connection with this type of transaction because only the remainder interest in the trust is valued for gift tax purposes. There's a technique called a zero GRAT where you create a very short-term GRAT and you're able to substantially reduce your estate tax. In other words, the amount that ultimately passes to your children once these GRATs expire by reason of the fact that the annuity is at a high level. It's a complicated actuarial calculation. Congress never liked those. They're a little bit too good to be true. So Bernie would want to reduce or increase the minimum term for GRATs to 10 years and make some other changes that would really kind of take the wind out of the GRAT as a planning technique. GRAT is a very important technique for clients who don't have much of their exemption left. And I'll leave it to you to kind of look at the outline if you're interested in it. It's too complicated for this discussion. But we do a lot of them and they've been very effective. This will make them substantially less effective. We talked about that already. He also wants to change the scope of what's called a generation skipping trust. Today, in a state that has repealed the rule against perpetuities, Donald, you know what that is, right? If you could theoretically set up a trust that could last for generation after generation after generation, and at every level, there's no estate tax. You know, that's what the Fords, the Rockefellers have done. That's why you've got fifth or sixth generation members of those families enjoying these substantial trusts that were set up decades ago. The new legislation would reduce the length of a trust that could continue for 50 to only 50 years. Thereafter, any distribution from that trust would be subject to what's called the generation skipping transfer tax, which is a 40% tax, which would go up to 45%. Sanders also wants to eliminate or reduce the annual exclusion and basically eliminate its use if you make gifts to trusts. The annual exclusion is the amount that anybody can give away to any one donee every year, free of estate tax and free of using your exemption amount. It's currently $15,000 per year, $30,000 for a married couple. That would substantially reduce opportunities to give assets away during lifetime. If you had 5 children and 12 grandchildren and you were using your annual exclusion, you can give away 17 times 15 times 2 every year without even using up any of your exemptions. So it's been very powerful planning and it's been beneficial for families who want to save estate tax. And that's the reason that this proposal would pretty much knock it out. That's Bernie. Senator Von Hollen has proposed, and he's got a one agenda item that at the time of your death or at the time that you make a gift of assets valued at more than 1 million at death and 100,000 during life, you are going to recognize the gain. In other words, the built-in gain. So if I have a business asset and my basis in that asset is 0, and it's now worth $10 million, if I died owning that asset, 9 million of that gain would be subject to a capital gains tax payable by the heirs, like an estate tax, although you can defer the tax over a 15-year payment period. But the rate, you know, if all of this goes forward or all of these things are kind of commingled, would be at close to 40%. Today, when you die, you pay an estate tax potentially, but then there's no income tax, and the basis of the asset, in my example, 0 basis, 10 million value, is stepped up to fair market value at death. So that $10 million built-in gain on that asset disappears. The basis in the hands of the transferee becomes $10 million, and it's never recognized. That has been part of the estate and gift law from the beginning. It's from time to time it has been proposed that we eliminate the step up in basis. It's never caught hold. And it would be a very serious setback for taxpayers who have been able to pass wealth without incurring income taxes, which is only fair because you may in fact be subject to an estate tax. So that would be effectively a doubling of the tax. This guy, Senator Thune, wants to get rid of the whole thing altogether. There's a bill floating around Congress to eliminate the death tax. I believe that's chance of passing are 0. Biden had the most sweeping potential changes in the law. Sorry. These are going to be problems for all of us if even some of these get through. It will change your long-term financial planning, your retirement planning. It will change what our clients are going to be doing. We have all relied on the ability to accumulate wealth within assets, whether it's business assets, real estate, other things. And when you finally dispose of it, you get the benefit of a 20% income tax, which is doable, manageable, right? If you die owning that asset, that you don't even pay the 20%. The basis is stepped up to fair market value, and the asset passes and that gain is never recognized. Biden wants to eliminate all of that. First of all, he wants to increase the ordinary income rate to 39 for 6%. That's what it was in 2016. It would hit at married taxpayers at 539.3. Today, the rate is 37%, the highest rate, and you don't get there until you have a family income of 650,000 for a couple. The threshold to hit the highest rate for individuals who are not married is lower. He would increase the capital gain rate to 39.6%. Which is also subject to the 3.8% Medicare surtax, for taxpayers with taxable income of over $1 million. So that would have a very significant effect on the items that I mentioned earlier. He would eliminate the step up in basis for assets passing at death after the first 1 million. Very serious consequences to most families who rely on that to manage their tax liabilities, both the income tax and estate tax liabilities. It gets worse. He wants to treat all income from self-employment. He wants to treat all pass-through income as self-employment income, whether or not you're a material participant in a business, and that would subject it to the Medicaid withholding and the Medicaid surtax. One of the things we do when we're planning for business owners is to set them up in S corporations. S corporations allow the owners to take salaries and bonuses, which are subject to self-employment taxes, Medicare, Medicaid, Social Security, and then also take a portion of their income in the form of dividends. Dividends are not subject to any of the self-employment taxes. This would change that. It would effectively make S corporations exactly the same as limited liability companies. So it's a little bit of a niggling at you on some additional taxes. The Medicaid tax is 2.3% and the surcharge is 3.8%. So that's north of 6% of additional tax on income that currently would escape those. This is important if you're planning real estate transactions this year. Under the Biden proposals, which obviously don't have an effective date because they're not introduced, the like-kind exchange, which is now only available for real estate, Trump took it away for every other asset class, would be effectively eliminated. In other words, the gain deferral would be limited to only $500,000 or $1 million for a married couple. So that would take the wind out of the like-kind exchange market completely. Again, aberrational thinking. He would treat allocable share income and gains from sales of carried interest as ordinary income subject to self-employment taxes. When we set up a partnership or an LLC, and a lot of the corporate people have done this and they're familiar with this. If you want to give a service provider an interest in the company in exchange for his providing services, well, that's a taxable receipt. If I receive shares of stock of my public company because I'm an employee and I don't pay for them, I have taxable income. One of the ways around that is to set up your business as an LLC or partnership and then give your employees what are called profits interests. Profits interests are not subject to taxation at the time that they're received, as long as the recipient makes what's called an 83B election. And when and if that when and if income and gains are allocated to that partner, they retain their character. So if the company has a capital gain and it's allocated through to the members, the profits interest holder also enjoys the treatment of that as a capital gain. This proposal would treat all allocable share income, regardless of the character, as ordinary income, subject to self-employment taxes and ordinary income taxes. And then when the profits interest holder sells his interest, which under current law would be a capital gain, that would also be ordinary income. So the attack there is on the use of profits interest in LLCs and partnerships to allow for compensating employees on a tax effective basis. Biden wants to increase the corporate rate to 28%. He's getting a lot of pushback on that, and he's apparently softening on it. He wants to make sure that every corporation pays 15% minimum tax regardless of their book earnings. So they could have tax losses due to certain tax favored deductions and still have book earnings. Well, he would want to tax their book earnings at 15%. He would reinstate the piece limitation on itemized deductions. Now, we don't have any itemized deductions left other than charitable and mortgage interest. He would put a cap on that. The piece limitation reduced the amount of your itemized deductions that you were allowed to take against your ordinary income. So, you may report 50,000 of itemized deductions, but because of the level of earnings that you have, only a small fraction of that is allowable. That went away under Trump. He wants to bring it back. He had originally talked about reinstating the state and local income tax deduction. The provision doesn't include anything on that. He also makes no changes in the estate tax, which is a surprise. That was on his agenda in the fall, but there is nothing in the bill. And he had thought about increasing the cap, changing the way Social Security taxes are withheld, such that if you made more than 400,000, you'd have to start having Social Security tax withheld on the amount in excess of 400. That didn't make it into his proposal either. There are many things that our clients are going to have to start to think about this year as these things develop. I mentioned a couple earlier. Number one, if you have an opportunity to sell an asset this year versus next year, I think that you should sell it this year. Whether you want to do a like-kind exchange or not is a bit problematic versus just recognizing the income on the sale of the property that is you intended to exchange for, because when you do a like-kind exchange, you carry over the tax basis to the new property so that when you sell the new property, you recognize the gain that you were allowed to defer. Well, if you have an opportunity to recognize it at 23.8% versus 43.8%, most of us would take the opportunity to recognize it at the lower rate, even in a like-kind exchange setting. The most significant thing we've been doing is talking to people about trying to capture this $11.7 million exemption, which we fear may end up going away. It definitely is going away in 2026. It might go away next year. There are a number of techniques that our clients can use to transfer assets. You know, a perfect scenario is you have a client who would gladly give away 23 million to trust for his children and grandchildren. He should give it away to trust for his children and grandchildren, and he should do it sooner than later. But what if you have a client that has $20 million? We have a lot of them, and they're not particularly comfortable giving away assets. What do you do then? What you can do then is create what's called a slat. I sent you an outline on this. A slat is basically a trust that you set up for your spouse. If you want to include your children and grandchildren as beneficiaries, they can be included as beneficiaries. You give the assets to the trust. You don't qualify the trust for the marital deduction. It's a taxable gift to the trust. So you've used up your exemption, right? So you've made a gift of $11.7 million. If the exemption is reduced in the future, you get to keep the amount in excess of the reduced exemption. It'll never be subject to estate tax or gift tax. And all you've really done is moved it from your left pocket to your right pocket, because your spouse is a beneficiary and can be the trustee of the slat. So if you need the money, or you look back and you say, I really shouldn't have done that, the assets are available to your spouse. If you don't need it, you can use the money to fund your children and grandchildren's education or anything you want to, or you could just let it accumulate, and at the death of the surviving spouse, whatever's in there, however big it got, is exempt from federal and state estate tax. So that is the technique that we're talking to a lot of clients about. Marty and Lisa and I have done 80 slats since the fall. I do a couple a week. Our clients love them. It's kind of a no-brainer. Any clients that you work with that have any accumulation of wealth, you should be talking to them about this, because this window is going to close. Will it be 2026? Will it be next year? Will it be the following year? We have no way to predict that. But the point is, this is an opportunity that will be lost. And if you can afford to do it, and the slat, you know, is the way to make it affordable, they should be seriously thinking about doing it. We talked about some of the other techniques that are going to erode away, such as the GRAT. Anybody who's interested in a GRAT or wants to know how that works, it's a very cool and very effective planning strategy. You know, talk to me about it, because we can still do them this year, and we can do them in the very aggressive manner that we do them. So that's an opportunity that I think will change very substantially after this year. So there's a chance for that as well. I'm going to pause and take any questions from anybody. Or not. We only needed to do 55, so you're off the hook. Questions? No? Okay. Well, you know, look at the materials, and I tried to make them simple, and, you know, make sure your clients know that the world's changing around them, and there's some opportunities that they could potentially miss out on. And thank you. Anything to close, Blake?
No, that's it. If nobody has any questions, I guess we'll convene. Enjoy your weekends.
Thanks, Steve.
Thanks, everyone. Stay well. Thank you.
Thanks.
Bye now.
Thank you.
Thank you.
Thanks, Steve.